Happy Wednesday to everybody. Welcome back to the Kansas City Commercial Real Estate Market Pulse, sponsored by our company, Midwest Commercial Real Estate Advisors. I'm your host, Logan Freeman. I'm here every single week interviewing studs like Venkat and other people in the industry doing really cool, awesome real estate deals. But my goal also is to get you introduced to our team. There's me on the left side, managing broker. If you've ever done any real estate deals with us, then you have most definitely interacted with Katie Cobb Sullivan, our brokerage and growth coordinator. Micah is focused on some multifamily properties here in Kansas City, but currently he does have some retail and he has some land. You should connect with him. He's got some really interesting projects. Nathan is my right-hand guy on our flex industrial projects and what we do on the office side as well. Nick Morales is doing all kinds of land and rehistoric adaptive use projects. And if you have any type of healthcare need, Chad Kagi has got you covered. So, I've been really intentional about building this team, out over the last couple of years. And I do believe we have a really solid team. And our focus is really dedicated to delivering top-notch service and results in a different way. And if you've interacted with us, you definitely know that speed is something that we value. We have a lot of market intelligence that we are tracking on a regular basis. We're utilizing AI in just about every single process that we have. And we have a collaborative approach. We love working with other brokers here in Kansas City and across the metro. So we're looking forward to sharing some insights with you all today. And that's what we do here on the Market Pulse. And our aim is to deliver these valuable insights to you guys, whether that be current listings that we have through our deal spotlights, market trends, going through one of our market updates and reports, going through the transaction overviews. I love doing quarterly transaction overviews to see where the commercial real estate market has been so that we can try and remember the future and to see what is come so that you, the listener, can position yourself, your team, your company, your portfolio to ensure you're making the right next moves. So Midwest Commercial Real Estate Advisors, thank you for sponsoring the podcast, the LinkedIn show. We are here live on LinkedIn and over on YouTube. Make sure to follow, like, and subscribe to our show. If you have questions, this is a unique show. We are live. We are monitoring the comments on LinkedIn. We are monitoring questions on YouTube. So if you've got anything for Venkat or for myself today, make sure that you get those asked. Okay. Today's guest, I've known Venkat for quite some time. We have actually been on multiple panels together speaking about commercial real estate across the metro area here in Kansas City. For myself, Venkat in the Sun Belt mostly, but he's the founder of Stryker Properties. He transitioned from tech to real estate, 3,600 units acquired, 2,700 units developed, $900 million of assets under management. Guys, if you're there following me on LinkedIn, you hear me talking about developing real estate. You hear me talking about syndications and how to get started in this industry. You've got a leader in the space here today, and I'm going to let him give some more background, Venkat. So for those of them that might not know you, why don't we share a little bit about your background, how you got into commercial real estate, and we've got some good information here that I'd love for you to share on when you had your kind of major career shift from tech into real estate. So we're going to talk about that catalyst. So Venkat, welcome to the show, man. How have you been?
Thank you. Thanks for having me. All right. So, I started in technology. So I came to US originally from India, came here when I was 22 back in 2002. Went to school, got my master's degree in electrical engineering. I came here, all the jobs went to India. Yep. So there was no entry level jobs to be had in electrical engineering, chip design. Now it's pretty hard. I would have easily landed a job in NVIDIA or something, but back then, not so much. So I ended up in IT, spent 14 years in IT. My last job was with a Bank of America.
Okay.
So I started buying real estate on the side back in 2007, just like rentals. I have no vision to scale this big. Just started it as not related to stock market. I keep losing money in the stock market 3 years in a row. And I say, you know what? I'm not built for this.
Sure.
And back then there was not much information about stocks and stuff. Right now you open YouTube, you get a ton of information, good, bad, and everything.
Yeah. Yeah.
But back then there wasn't any. So that's why, I need something more predictable. And then that coincided with the mortgage foreclosures and all that. So I ended up buying about 20 properties on my own over the years. And then they said that no more loans for you. Fannie only want to fund the first 20, and after that they won't. So that is when that was a catalyst. I made some passive investments in 2014. 2015 is when I jumped into commercial real estate as a sponsor. And then over the time, in the next 5 years, I built a portfolio of 3,600 units, mostly B and C class, 60s, 70s, 80s. I was chasing yield. And life was good until COVID rolled in. And then, like eviction moratoriums and all the thing. See, what happened was that we printed 50% of the money between 2020 and 2022.
50%.
50%. We were at $15 trillion M2 money supply at the cusp of COVID. And we closed our eyes and opened, and we were at 22. So we printed next 10 years worth of money in 2 years. I mean, and then everybody knows what happened, right? The inflation and all that. So what it did is people were not getting 50%, jump in their income, right? I mean, we printed 50% money. Everybody's house is worth 50% more. But the salary, the guy who's making 40,000, he's not making 60,000. He's maybe making 45,000. So that put this B and C class tenants under enormous stress. And I have seen that writing on the wall. And then in September 2021, I sold all my portfolio in Dallas. I still have about 400 units left in Phoenix and Denver. But Texas, I got out of it because that coincided with this rampant property tax hike cycle. So Texas was like very laid back in Texas. If you pay $100,000, they were taxing you on 60,000. And everybody knows that. That's how it was. And then they kicked into 70, 80, 90, 100, 105, right? All in 2 to 3 years, right? So that put enormous strain on finances and also. So I saw where this was trending and then took opportunity of the low interest rates and offloaded all my properties. So I don't own any B and C class properties in Texas. I own a class A that I just completed built. I sold one before, and there's several more I'm building. So that's pretty much what I'm doing in Texas. But yeah, I mean, I pivoted from tech, from electrical engineering to IT, from IT to rental homes, and from rental homes to commercial real estate. I was buying B and C class value adds, and then I'm into development now. I do some land deals, some car washes and things as well, or some retail as well. But for the most part, 99% of my focus is on ground up development, multifamily, because I want to deal with the class A properties. So these tenants are high quality because they either have skills or degrees, you know what, somebody's making $80,000. They can make ends meet no more. They go to the boss and say, the boss, I need 95, or 80 or 85 or whatever. Otherwise I walk. And they can walk because they have marketable skills. We are a service-based economy. So there is demand for such that sort of thing, right? Let's say if you're a plumber, an electrician, or an accountant, these are the things like, where you can just walk and make more income so that you can pay rent. B and C, not so much, because it's mostly unskilled labor. See, every job needs a skill, but the supply is abundant in that. The labor supply is abundant in that area. So that's why they don't have the pricing power. So with that mindset, I went after Class A properties and tried to buy existing properties, wrote a couple of offers and all that. They were insane, right? I mean, I don't know how we're going to make money paying 4.5 cap. I know it's a Class A property, but you have to wait for 25 years. Right. And my cycle is only for 5 years max. And that's when I got into ground up development where I can make the spread. One way or the other, my target at that time, I was shooting for 21 IRR for investors net of fees. And you cannot do that buying a 4.5 cap Class A property. Right. Just impossible, So that's why I went into ground up development.
Okay.
So
yeah. Incredible. So your journey spans now 20 years, Venkat, in the real estate space.
Absolutely.
So, I mean, that is an incredible journey. Many folks are not in the industry for that period of time, and you have done, a lot of different things within that. But your entry into the space was just buying some rental properties, getting maxed out on the governmental loans that you could have, and then deciding not to go do some DSCR or private money loans, right? Because those can get you into some hot water.
I
But
know.
there is a tool that's a tool for some folks, right? But like at the same time, you've now been through, I don't know, 2 cycles. I mean, pretty close to 2
Absolutely.
cycles. Yes,
2008 cycle and the recent cycle. Yeah.
yes, and the one that we're still in the middle of, and I think is
And the
going
one
to.
we are in is worse than
Yes,
2008, and there is no recession. Lot
yeah,
many people don't know that, but across Sunbelt, rents have been falling for 3 years. 3 years.
3 years of
So
falling rents.
yeah,
Wow, wow,
yeah.
and that's because of the supply and the massive amount of starts that we have.
Yeah, that's pretty much it. And also, what happened is people. Yesterday, I was seeing a statistic. So there's 10 million more people who work from home now than we did before COVID. 10
Wow,
million people, right? We only have 160 million working people. So this 10
mhm.
million is not, I know it's a smaller percentage, but it's not a small number. So what happened is like these people moved away or, they live in a third tier city or something. They don't have to live in Dallas, Austin, New York, Florida, and all that, right? So that's one aspect. But the major aspect was the supply, right? Because all the people who were like not going to office and all that, right? So they needed apartments. So for a short while there, the market tricked us to believe that the demand is much more than what it would have been down the line once the
Yeah.
COVID and everything opens up and the offices opened up and all that, right? So there was a shrink in the demand. 2023 was a horrible year, negative net demand. 24 was a great year. 25 was even a great year. So I no longer can complain about demand, which is all-time high. It's not what we thought it would be, but it's still all-time high. Right now,
Sure.
it's running all-time high. But our supply is even higher than all-time high, right? Like way up there. So it took this long to consume all that.
Okay.
And
Yeah.
then this inflation, right? I mean, look, a lot of people now.
Well, it looks like we may have lost Venkat. I'm hoping that he'll pop back in here very soon. I think the connection was a little bit shoddy on that end, so hopefully he'll be popping back here. But I mean, what he's talking about is even though we have major demand in the Sun Belt areas, right, and other areas of the United States, there is such a high supply that demand is not being felt throughout the multifamily market because of where the supply was. Now, I think something for people to be thinking about here very, very soon is where starts are right now. Okay, we got them back. I'm adding
I'm
them
so
back in.
sorry. Yesterday evening we had this crazy storm here in Plano, and ever since the internet has been acting up. I do have a 2 gig up, 2 gig down, but sorry about it, guys.
That's okay. Yeah. So where we
Yeah.
were talking about kind of was
So it
where
was
the
yeah.
inflation is
So
right where we lost you, right around the inflation side.
yeah. So that's the problem, right? I mean, so we have this insane supply which was unleashed on us. People's purchasing power is shot. It's catching up. It's catching up. Technically, inflation is lower than the wage growth, so it's catching up. But it's going to take some time for the demand to just come out. And kids, right? I mean, like early 20s, these are the people who usually dwell in apartments for the most part. And these people, these folks, I mean, our job market is not that great, right? So these people are not moving out of their parents' basements and getting a job, renting apartments and all that. So all coupled, that's why it was delayed. I mean, 3 years of rent drop. I mean, I don't know which business can survive, right? But yeah, that's what we are going through. We are at the tail end, and by conservatively spring next year, there are some markets in Austin and Dallas have already turned positive rent growth. Some submarkets, I would say like 10% of the submarkets already are positive, but I think it'll be at least spring next year before all the submarkets turn positive.
Yeah. Well, we kind of touched on the cycle that we're in right now, Venkat, and I mean you've been through two, right? And I love frameworks. I'm a big studier of the history of real estate cycles, trying to figure out kind of where we're at. This framework with Akhil Patel and Phil Anderson and Fred Harrison of the 18.6-year real estate cycle has me very interested. I don't think you ever can put your finger exactly on where it's at, but I do believe we are in that mania or winner's curse phase, and a lot of people aren't prepared for maybe a downturn, right? And when that happens is to be determined, but there's a lot of things pointing in that direction. 2025, we're seeing, at least in the commercial real estate market, transaction volumes that are hopefully going to mimic, and be 2024's, but we're still way low. I mean, we're at like 2003, 2004 levels. But prices in a lot of different areas are kind of trickling back up. And I mean, I could talk to that in Kansas City, specifically around just land prices in general. But I'm curious to kind of just get your feedback in regards to how you're kind of thinking about where we're at currently and what you're focused on and trying to prepare for this next cycle, whether that be for the next 2 to 3 years. What do the strategies kind of look like?
So first, we have to look at the interest rates, right? So 10-year is around 4.2%. The short-term interest rates do matter, but 10-year treasury matters even more, right? 4.2 is still high. We need something with a 3 handle, like a 3.5, 3.75 or something like that.
Sure.
And I think the current administration is doing in their own way, right? I mean, it's very chaotic, but in their own way, they're trying to solve the deficit problem, which would put downward pressure on the yields. They brought in this stablecoin legislation, which apparently is estimated to bring $2 trillion new demand for treasuries. So it's kind of contingent upon how the interest rates will perform over the next 2-3 years. But we have already started seeing some positivity for high quality assets.
Yeah.
B and C, they are short. I don't know when they will come back up. But in North Dallas, from Cushman, I got some comps that I was looking at early this year, the deals that traded in the last 6 months. I have seen almost all of them are sub 5 cap. I mean, it makes you scratch your head. It's like, how are they trading, right? Under 5 sub cap.
Right.
They're not getting 5% interest rate. Maybe they are, but so where's the spread between the cap rate and so there's a lot of positivity. And also after hearing the earnings calls from Equity Residential and all these people, they're talking about stabilizing OPEX. And the renewals were good, and they all started to see rent bumps and all that. So I'm very positive. It will not be anywhere close to what we have seen in 2021.
Right.
But it'll be a lot better. Maybe 2 to 3% rent growth is what we can expect for next 2 to 3 years. Barring if this current administration is doing so many things to pump up the market, one of them being rate cuts. If they all worked out, then we can see a much more favorable outcome. But my worry is about 10-year treasury, right? There's so many things which are working against it because our debt is bloated. And Japan, who've been buying our USDs because their 10-year used to yield like half a point, right? And the short term was negative. So if you put the money in the bank, you have to pay the bank interest rate, right? That's how it was not too long ago. But now their 10-year is, I think, approaching 2%. Ours is 4.25, but there are hedging costs, right? So once you factor in the hedging cost, Japanese are saying, why should we buy USDs? We'll buy our own bonds,
Right.
Japanese government bonds, right? So that's our biggest creditor. If they are withdrawing, China is withdrawing because we put sanctions on Russia and froze their money. So they're withdrawing. We're putting tariffs on everybody. So that just concerns me that the demand for the treasuries is like that. So yeah, that's our biggest risk. At the end of the day, it all boils down to interest rate, right? I mean, once that is taken care of. But I'm cautiously optimistic for the next 2 to 3 years. I already started to see things turn around in the Sun Belt.
Well, I think you mentioned two things in my framework, not my framework, the framework that I follow or I'm learning about quite a bit with the 18.6-year real estate cycle would say, hey, we've got this period of time, probably 12 to 18 months right now, where prices are going to continue to increase up. You just said you're seeing deals trade at sub 5 caps or around 5% cap rates. That is pretty incredible, for trophy assets in great markets. But also, if the Fed does, reduce interest rates, that's going to have, and I track capital flows, right? Because interest rates and capital flows aren't necessarily completely directly correlated, but there is a big correlation between them, right? But there's periods of time.
A lot of money printing will happen, Logan. What will happen is 90%. We think that government is printing all the money, but in actuality, 95% of the money is printed after the QE, right? Once we stop the QE, now 95% of the money is being printed by banks, like Bank of America, Chase Bank, your regional bank, credit union. Whenever they make a loan, they print money. Whenever the loan gets paid back, the money disappears. That's how it works. So when the interest rates go low, assets appreciate, collateral value appreciates, right? And volatility decreases, then collateral value increases, right? So then more loan making will happen, more money gets printed, and all the liquidity will flow into assets, stocks, Bitcoin, real estate, and all that. So your interest rates is a very big lever for liquidity creation, money printing, which will flow into everywhere. The thing is, like, everybody lowered their interest rates except for us. We did a little bit, but not anywhere close to EU. You had 10 or 12 cards. India is cutting. China is like near zero. So once we started cutting, we are the big dog, and the liquidity that will be unleashed, it'll be a huge tailwind, for the assets, for the risk assets.
Wow. So, okay. You heard it here. I mean, that's very similar to my thinking, and I think you laid that out very, very well. And
it goes in cycles. It goes in cycles, right? Sometimes everybody rate cut, everybody rate hikes. When we rate hike, people pay back loans.
Might have not lost Venkat again. We're right in the middle of talking about rate hikes and the liquidity that is created. Interest rates and cap rates not being directly correlated, but capital flows and cap rates being very directly correlated. Interest rates being one of the biggest levers that creates or removes liquidity within the system. So it's something that we absolutely have to keep our eyes on a regular basis. Those capital flows are what create the opportunity for that capital to go back into these assets. Go ahead. We lost you there for a second, but he's back again. So
what I was saying is it goes in cycles, right? I mean, there is a 40-year cycle that I'm hearing. 1940.
Really apologize about the delays and the connection that we've got here. I know the Venkat said there was a big storm that was going through Dallas, Fort Worth, and his location. So hopefully we'll get him back here in just a second. But we were talking through cycles and understanding that everything happens in a cycle. And, where we're at right now is somewhere where you need to understand where we're at in that real estate cycle. We've talked about this quite a bit on this show, but Venkat is, been able to navigate these multiple cycles through 2008, as well as the current cycle that we're in. So we want to get some more insights into where he believes, the next 2 to 3 years is. It's good to hear that they are seeing, some serious cap rate compression on those trophy assets. Additionally, as well as that he's cautiously optimistic over the next 2 to 3 years in regards to where we might be for commercial real estate. And I think that he's putting his money where his mouth is, right? Like actually selling off the B and C assets and focusing on A assets and actually going in and developing that spread to ensure that he can capture that for himself and for his investors. That is a strategic pivot, and I'm not seeing a lot of people actually go through a pivot very similar to that, and that's not easy to do, right? And he's built up this skill set of being able to go from acquiring existing assets to then actually developing these assets. All right, we got him back, so I'm going to add him back in.
So embarrassing, man. This is
it's cool because I get to take what you're saying and then kind of give my 2 cents there, but I know it's probably frustrating.
Yeah. So 1980 onwards, there was a downtrend, right? Before that, 40 years of uptrend in the interest rates, and now it was downtrend. Now they're saying there's another 40 years of uptrend. Of course, it won't go in a straight line. It's goes zigzag pattern. So we got to be super careful. It's whatever we know before 2020, we have to forget about.
Venkat was just talking about kind of a 40-year uptrend cycle that we've potentially walking into, right? And I think that inside of that 40-year cycle, which is probably more or less the big debt cycle, the long-term debt cycle that Ray Dalio talks about, Howard Marks talks about, there are interim cycles within that, right? So if you take 2 of those long-term debt cycles, you could think about there's probably 2 18.6-year real estate cycles inside of the long-term debt cycle that he is referring to. We have to mention, new technology and how that's going to, think about this. I heard somebody the other day talk about, well, they said it was location for real estate, but they said, it's actually jobs, because that is what creates the businesses that are inside of your real estate, as well as provides the actual residents that are going to live in the multifamily. So that is why so many folks like Venkat, myself, are tracking the jobs and the job creation and where we at with occupation, where we at with people in their jobs, unemployment records and percentages that we're at right there too. So, 40-year cycle, Venkat.
Yeah, something is happening in my area. Even my cell phone is the personal hotspot is not working as well. So not sure what it is. It was fine this morning, but yeah, the 40-year cycle. So my point is that, we got to be very apprehensive of interest rates going forward.
Sure.
We're not going to go back to like 3% 10-year treasury, 2.5% 10-year treasury. That ain't going to happen anymore.
Right. Yeah. No, totally makes sense. So, I mean, as you think about that, in regards to, what the next 2 to 3 year outlook is, you're doing development deals now. And so, how do you think about this from a developer standpoint where, I don't know what the development timeline is to get a deal, entitled to actually, stabilize or built and delivering that. But the development side can be somewhat tricky because how that's going to look in 2 to 3 years is a lot different than now. So how are you navigating that right now?
No, see, even people who are buying right now, they are not putting 10-year treasury, right? 10-year rate. They're buying with 5 years, some with bridge and all that. Everybody's hoping that the rates go down. It's really hard to make deals pencil by putting a 10-year loan on it, right, these days. So we are all in the same bucket, but the current administration is determined. I mean, they did say that, right? Like, look, measure us from 10-year performance, not the stock market performance, right? So finally, they started caring about Main Street, us. But it takes about 3 years, right? Once you break ground, it takes about 18 months to 2 years to build it. And then we have to quickly lease it up and either sell or refinance at that point. I mean, depending on what the business plan is.
Yeah, absolutely. Well, I'm going to get into some quick takes real quick with you. I'm going to put these up on the screen. I know that you're a big reader and ingesting a lot of information because I've been on panels. I've listened to you. I can hear it with what you're talking about right now. But maybe kind of point folks in the right direction. What's your favorite business or real estate book that you've read?
I would say there's a book written in early 20s by Dale Carnegie,
Oh,
How to
yeah.
Win Friends and Influence People. Really love that book. I mean,
Yeah,
especially us in real estate, we work with so many people to get
that's
things
right.
done. So if you don't know how to go about working with people, it's going to set us that much back, right? So
Absolutely. Absolutely. I mean, that's one of my favorite books that I read early on in my career. Dale Carnegie, this is a fun fact, did go to the college that I went to in Warrensburg, Missouri. So, University of Central Missouri, it was probably called something different back then, but very, very good book. And one of the things that really stood out to me in that is remembering people's names as well and using it when you're talking with them, but also, you can catch a lot more flies with a jar of honey than you can with a jar of gall. And so that is something that I've
absolutely.
always tried to remember. I had to look up what gall was, but that is an old term to say it's something gross, right? Vinegar, think something like that, right?
Yeah.
So making sure that every interaction with someone, you try to at least leave it better than when you came from, right? And that will take you far. So that's a great book. I love that book. One piece of advice that guided your career. There's a lot of folks listening in, and I get DMs in my LinkedIn on a regular basis. Man, how do I get started? What should I do? What is that piece of advice that you give? And I'm sure people are reaching out to you for the same thing.
No, absolutely right. So find somebody first you admire, right? I
Mm,
mean, it starts there. Okay, who do you want to be? Like, let's say
yeah,
you have a magic wand. Who do you want to be, right? And then emulate them. It's as simple as that. And then if you are comfortable in your skin, you're just not pushing yourself. That's what
yeah,
I would say. Nowadays, my God, I mean, a lot of complaining. I mean, things were so hard. I mean, it wasn't that cakewalk. I mean, market was okay, but everything today that we take granted, like raising millions of dollars, who would have thought 20 years back? There's no way. Right
yes,
now you can, yeah, just so many ways to get things done. So my thing is like, just emulate somebody, admire somebody, fix on them, and study them and emulate them, and if
yeah,
possible, work with them. That's the best way. See, look, nobody's getting younger, right? So let's say if I want to emulate somebody, right, I'm sure that person didn't get there in a straight line.
right,
Maybe his career was zigzag pattern. Our career doesn't need to be zigzag to that extent, right? So go work with them, get a mentor, learn everything that he's willing to teach you, and then apply it.
yeah. That's good feedback. It's good feedback. What outside of interest rates, what's one commercial real estate trend that you think that everybody should be watching right now? What's got your eye?
I think retail is coming back. There was a Amazon shock in 2015
Yeah.
time around thereabouts, and suddenly we had a glut.
Well, I definitely second his thought on retail. As he times out again here, retail shopping centers, especially neighborhood retail shopping centers, being one of what Wall Street Journal is calling the darling of the commercial real estate industry. It is back in full effect, primarily because of essential businesses, but also the demand from new businesses getting started, the continuation of the growth of small businesses, medium-sized businesses in the United States, and the supply that has not been created for this neighborhood retail shopping center. So, that is something that I absolutely second and agree with 100%. We're probably going to get him back here in just 1 second to kind of talk through, you know, the retail shopping centers. But I like that idea quite a bit. We've seen that play out in Kansas City, across the Midwest, and lots of investors kind of pouring back into the retail shopping centers. Look, guys, hey, I really appreciate you sticking with us today throughout all the timeouts and things like that. I'm going to put Venkat on just for a second. Venkat, if people want to follow you, where can they find you and find out more information? We're likely going to need to have you back on in about 30 days when
Yeah,
we get the internet fixed, and we'll dive
absolutely.
deep into some more of this stuff. But if they want to follow or learn more about Stryker Properties, point them in the right direction for us.
Our website would be a right place. Stryker, Stryker properties.com.
Great.
So from there you can actually make a connection with
Yes,
me.
absolutely. Well, thanks for sticking out with us Venkat. I know that was frustrating, but there was still a lot of information shared, a lot of good nuggets that you were able to bring to the table for us today. So very much appreciate that. If you're interested in commercial real estate, land development here in Kansas and Missouri, and really the Midwest proper, make sure to reach out to us at mwcreadvisors.com. Head over to our current listings. We have close to $60 million of deals listed right now or under contract. We closed 6 projects in July. Got a bunch more coming up here in August and September. I was telling Venkat, we've got some office properties that are getting a lot of attention, believe it or not, something that we'll get into the next time that we have them on. But thank you all for tuning in for another episode. This is episode 31 of the Kansas City Commercial Real Estate Market Pulse, sponsored by Midwest Commercial Real Estate Advisors. We appreciate you tuning in, and we'll see you again next week. Thank you, Venkat, for joining us. We really appreciate it. I'm just going to end this stream.